Looks like Donald Trump is going to be reelected, will be the next U.S. president. What does this mean for risk assets? I'm going to cover it all in this video. You're watching Unrivaled Investing. My name is Daniel. Let's dive right into the signals that we're seeing, the pricing action that we're seeing. Well, first of all, you're seeing the futures, S&P 500, NASDAQ, both surging higher, both up over 1% in the after hours. This does suggest that the market is anticipating the tax cuts, the corporate tax cuts that President Trump has talked about, encouraging for his next term, also talking about potential stimulus for the economy. So this is suggesting, hey, he's going to be able to keep, a already solid economy humming along, maybe even, stimulate it a little bit more, put some pedal to the metal. And, this will be a businessman encouraging a favorable business environment. That's what you're seeing with the market futures. And you see crypto, particularly Bitcoin, ripping higher, up 8-9%. Also in the after hours, as previously Trump had talked about America being the world leader in cryptocurrency, and Bitcoin is arguably the largest and most influential play within the crypto space. Oil assets are actually flat to down, partly because he's talked about repeatedly, look, he's going to drill, baby, drill. And he's also talked about bringing maybe some force, maybe some, a tougher act in the Middle East, maybe sanctions back on Iran. So, putting in some sort of environment where you either have a lot more oil, or based on just a show of strength, you have potentially less volatility in the Middle East, and so you do not have some sort of premium on where oil goes in the future. So you have these dynamics. So oil, a little bit weaker based on the prospect of increasing supply, as well as possibly more peace in the Middle East from a more aggressive, stronger positioning. You also see broadly these risk assets in line with JD Vance, the future vice president's portfolio. As you could see, this is based on a regulatory filing that he had to file, showing that the QQQ is his largest holding. So this is representing the NASDAQ. He also has a stake in the S&P ETF, also has some gold, also has some Bitcoin. But by and large, looking at the NASDAQ as being his biggest exposure, he also does have some long-dated U.S. Treasuries, but it's much smaller relative to the risk assets like the S&P and the NASDAQ and gold and Bitcoin. So it is worth calling that out. Now, just because he has a sizable, let's say, NASDAQ exposure doesn't mean that all big tech will do well. I think you might have some sort of shakeup if Donald Trump indeed does come to power, because, you have seen instances where there has been, seemingly double-sided reporting, and Trump has talked about avoiding Google in interviews. And, there have been mixed search results where if you type in, Vice President Harris versus Trump and, what type of articles you're seeing. And even Senator JD Vance has talked about Meta platforms, talking about breaking them up. Should they really own both Facebook and Instagram? And, should Google also own YouTube? So I'd say the odds of a split do not necessarily go lower with Donald Trump becoming the next president. If anything, I would say the odds that these platforms, the big tech, I'd say there's an increased odds of uncertainty for that they will look the way they will today in the future. I think it's much higher probability that they will be different businesses, fundamentally, maybe forced by law in the years ahead, based on sort of maybe a retribution by the next incoming president and his vice president. But not all big tech stocks could come under pressure or be threatened. Look, NASDAQ's JD Vance's largest position, and you're seeing NASDAQ clearly rally. Tesla stock is surging also in the after hours, up something like 8%. I personally am a little skeptical that this is going to lead, let's say, a rally. I would say this has bought insurance that, there's no crazy lawsuits against Elon Musk and his various different companies. And you've definitely seen that sort of lawfare approach, with the current administration, the previous Biden administration. And so I would say this spike that you see in Tesla, it's going to need to be earned with the underlying fundamentals of Tesla. You're going to need to see, the robot cars, the Optimus, really to get that rally going. Because at this point, there's a lot of hype already in the stock. But clearly, this is a favorable development for Elon Musk and for his various different entities. Now, what about Trump Media and Technology Group, or DJT? stock. Personally, I think this is just something that's kind of a joke. It should be avoided. You're talking about a multi-billion-dollar market cap, and during the most recent quarter, they had a decline in revenue to around $1 million. $1 million in revenue versus 6.8 billion market cap. That's $1 million in revenue for the quarter. So it's just, this is something that you could wake up and it's 99% lower. I think it's important to recognize a lot of speculators, a lot of gamblers like to play around like a casino chip, and they like to move things around, not necessarily tied at all to any sort of fundamental value. And I think this is really, that's what you're seeing here with Donald Trump social media. I think that's important to recognize. Now, just because you could see risk assets broadly, bull market, everyone's excited. Just because you do have, you are seeing those signals, and maybe even a rosy golden age, rosy period, golden age ahead. There are some aspects that I think investors do need to be mindful of that could disrupt the whole thing. One in particular really comes to mind. We're going to talk about that in just one second. As always, this is not financial advice. Also, recently, Michael, a premium member of the Unrivaled Investing community, shared, this is a direct quote, "So far, the subscription has paid for itself in 3 months. Looking forward to what the future holds. I'm raising prices at the end of this month, so now is the time to lock it in." This is at unrivaledinvesting.com for compelling investment ideas. I think the key here, this is the one big concept that really can wreck assets. It can wreck the stock market, it can wreck the NASDAQ, it can wreck crypto, in my opinion. The one key asset that is the tell that sort of this could be the music, and the music stops and then everyone's searching for a chair, is, I think, looking at the bond markets with the U.S. Treasuries. And you're seeing a surge in 10-year Treasury yield from 4.3% before the election to 4.45%. So you can see this is when Jerome Powell cut rates by 0.5%. Since then, the bond markets have largely said, nope, rates are actually going higher, not lower. And so now you're effectively, nearly 1% higher than where you were when Jerome Powell cut rates. And so this is the elephant in the room. I'd argue there's many, many elephants in the room, because this is one of the most important markets, in terms of all capital markets. And if this, and this is how assets are priced. They're priced on the risk-free rate, which is supposed to be U.S. Treasuries. Sometimes you're using the 10-year Treasury. And so if you were to say, hey, this yield starts going higher because there's questions that you can keep your deficit spending under control, or that you're going to blow out the budget. So this is going to start turning into, will Elon Musk come in with the, government Department of Efficiency and start really, I think it was called something like DOGE, where it's Department of Governmental Efficiency, where it's all about, hey, can we possibly cut $1 trillion from government spending? And if you were to have something draconian like that, like what he's pulled with Twitter, I would say that could truly be a golden age for asset prices, because then you have, the tax cuts, and then you say, hey, we're not going to be, the U.S. government's not going to have poor spending. And by the way, we're going to balance, this austerity with appropriate stimulus, so it sort of balances it out, maybe. So that's the sort of the mega bull scenario, where you're no longer worried about Treasury yields exploding higher. But this is a big deal. If this were to go to, if this were to, let's say, go back to new highs, where you're talking about closer to 5%, I think you would see a reset, in terms of asset prices, including crypto, where folks start saying to themselves, wait a second, it's not only how you price things, it's also all the legacy institutions that start having some serious heartburn. And we've seen Warren Buffett blowing out of billions of dollars in his Bank of America stake. It's still a sizable position, but he sold billions of dollars, in large part because of the mismanagement of how they've made these loans that were previously done at, let's say, 2 to 3%. All of a sudden, you have an interest rate environment that's 4 to 5%, and then you have to get a spread on top of that. And that loan portfolio gets a sizable markdown. If you go into a period where the bond vigilantes start coming out and people start saying, hey, I'm worried about the credit quality of the United States, that is a major reset across all asset classes. So it's not only the pricing of how this works, it's also the secondary effects of the institutions, because then you start worrying, what are the major institutions that could be in trouble? And then maybe it's maybe you're also talking about foreign banks and not only the U.S. banks, but also mega players. Which central banks around the world are now, in questionable territory where they're going to have to start printing more money. So I think it is important to recognize that the elephant in the room, one of the most important assets to look at actually is the U.S. Treasury market, because it is falling. This is the yield. The yield is jumping higher. The price of the bonds are falling. So right now you're sort of in this Goldilocks of, hey, risk assets are jumping higher and bonds are selling off. There's a chance though that you could see, a period where it tips over to where investors start saying, wait a second, if I can get, 5% on a U.S. Treasury, if it keeps going that way, then, do I still want to own risk assets? And then it also starts squeezing the economy as well, because as interest rates move higher, that is it's sort of like a snake around your neck. It's coiling and getting tighter. That the higher interest rate does play a role in the economy. And I think one of the key reasons why we haven't seen a recession, despite the fact that Jerome Powell did raise rates from 0 to 5%, is there was so much stimulus, so much deficit spending that effectively the U.S. government sort of printed its way through a recession, despite the fact that there was such monetary tightening. So if you have some sort of situation where the bond market starts going off the rails, that is the key risk to be mindful of. I'm not saying it's going to happen for sure. I'm just saying it's something to be mindful of. My personal view, as I look at investing, is that playing this macro game and sort of saying this asset class is going to do well, this is not going to do well, that's very, very hard. There are a few players who do it exceptionally well, but they're few and far between. They're like the Stanley Druckenmillers, the Paul Tudor Jones. My personal game that's much more enjoyable for me is to find these companies where, whether or not you're at a 7% interest rate environment or a 0% interest rate environment, I feel confident that the management, the CEO is, sitting tight and knows the business inside and out and is prepared for those shocks. Because if you have, this is one of the key items on my investment checklist, which is an aligned management team. Ideally, you have founders. When you have founders running the company, you're more likely that the founder has thought about these types of risks. Like, oh snap, what happens if interest rates go to 7%? They're not just checking in for, hey, what are the earnings this quarter? They're thinking about building for their legacy. This is their pride of ownership. So they're thinking about, how do we build this entity for the long term? And they're more likely to consider these types of economic shock factors. So that's how I personally get around the uncertainty and the risks of thinking about the macro, trying to find aligned management teams, ideally management that has already proven their track record. I'm talking this week in a letter, I'm talking about a company that's clearly could benefit from higher interest rates. They have a sizable bond portfolio and they have a CEO, that's been with the company for several decades, creating, huge value that's way outperformed the broader markets over time. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.